Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money behind the business. And in this report, Egea Group Corp might be selling snake oil or maybe just snake oil infused vitamins. Let's dive in because this report is a bit of a mixed bag and we've got some juicy financial tidbits to unpack. This is Egea Group Corp's quarterly report, essentially a check-in on how they're doing financially and operationally for the 3 months ending July 31st, 2025. Think of it as their financial report card for the quarter. Now, the big headline here is how they performed financially. Let's talk numbers because that's what really tells the story. Looking at their balance sheet, which is like a snapshot of what they own and what they owe, we see their cash situation. By July of 2025, they had about $1 million in cash, which is up from around $782,000 in April. That's a nice boost in cash. Now, their accounts receivable, that's the money customers owe them, has gone down quite a bit. It was about $1.2 million in April and dropped to just over $1 million by July. This could mean they collected payments faster or sold less on credit. Inventories also took a tumble from about $44,000 down to just over $9,000. This might suggest they sold off a good chunk of their product, or maybe they're just not holding as much stock. On the liability side, their accounts payable and accrued expenses, which is what they owe to suppliers and for other short-term things, went up slightly from $60,000 to $67,000. Nothing too alarming there. Now, for the total shareholders' equity, which represents the owner's stake in the company, it actually went down from about $1.9 million in April to around $1.86 million by July. While cash increased, other factors like retained earnings decreased, bringing down the overall equity. Let's move on to the operations statement. This is where we see how much money they made and spent. For the 3 months ending July 31st, 2025, their revenue was about $103,089.99. This is a slight decrease from the same period in 2024 when they brought in about $108,107. So revenue is down by about 4.2%. Their cost of revenue, the direct cost to provide their services or products, stayed pretty much flat around $35,000 for both periods. This means their gross profit, that's revenue minus cost of revenue, also decreased slightly from about $73 in 2024 to $68,781 in 2025. The gross profit margin stayed strong though, around 66 to 67%. Now, here's where things get interesting. Total operating expenses, which includes things like salaries and administrative costs, dropped significantly from about $187 in 2024 to $101,121 in 2025. That's a decrease of about 14.6%. Because of the revenue decrease and the drop in operating expenses, their loss before income tax narrowed from a loss of $45,414 in 2024 to a loss of $32,440 in 2025. So they're losing less money, which is a good sign. And this translates to a net loss of about $46,301 for the 3 months ending July 2025, compared to a larger net loss of $55,211 in the same period of the prior year. They're still losing money, but at a slower rate. Looking at their statement of changes in shareholders' equity, we can see how the different parts of their equity changed. As of May 1st, 2025, their total shareholders' equity was about $1.9 million. After accounting for the net loss and other changes during the quarter, it fell to about $1.86 million by the end of July 2025. Comparing this to the prior year, their equity was about $1.05 million on May 1st, 2024, and it grew to $1.001 million by July 31st, 2024. Interestingly, they had some share-based compensation that year, which added a bit to their equity. Let's talk about cash flow, how much cash is actually moving in and out of the business. The starting point again is their net loss. For July 2025, it was a loss of $46,301. Now, a big positive here was the change in accounts receivable. This was a positive $252,669, meaning they collected more money than they billed out in that period. That's a cash inflow and a very good sign. They also had a positive $55,118 from changes in inventories, likely because they sold more than they bought. All these adjustments, including the collections from receivables and inventory sales, turned their net loss into a positive net cash flow from operating activities of $263,810 for the 3 months ended July 2025. This is a dramatic turnaround from the previous year when they used $504,001 in operating activities. In financing activities for the 3 months ending July 2024, they received $52,600, which they note as proceeds from a related party. For the 3 months ending July 2025, there were no financing activities. So with strong positive cash flow from operations in 2025, their net change in cash was positive $263,810. Bringing their total cash to over $1 million. In 2024, their cash decreased by over $451,000. In terms of what the company actually does, they are involved in consulting advisory services in management, accounting, and finance. They also provide healthcare products and health consultation services. Their main subsidiary is NutriPeak Trading Corporation, which focuses on marketing and supplying healthcare products. They are following standard accounting practices, but they do point out that results for 3 months are not necessarily indicative of the whole year. When they recognize revenue, they do it when the performance obligation is satisfied. For healthcare products, this is upon delivery. For consulting services, it's over the period the services are performed. And this table breaks down where their revenue comes from. For the 3 months ending July 2025, they had about $4,225 from consulting service fee income, and the bulk, $99,604, came from sales of healthcare products. This is a big change from 2024, where all their revenue came from healthcare products. The company reports 2 main segments, the consulting service segment and the healthcare segment. For the 3 months ending July 2025, the healthcare segment brought in $99,674 in revenue, with most of that coming from sales of healthcare products. The consulting service segment, however, only generated $4,225 in revenue, and this segment had significant operating expenses, leading to a loss of $82,842 for the segment. Geographically, in July 2025, all their revenue came from the United States, about $103,899. This is a complete flip from July 2024, when all their revenue, $10,8,477, came from Hong Kong. They don't seem to have any allowance for credit losses, meaning they don't expect any of their receivables to go unpaid. This is a good sign of strong customer credit quality, or perhaps very strict credit policies. Their inventory mainly consists of finished goods gene code NR capsules. As we saw earlier, inventory levels decreased significantly. They paid income taxes with a total provision of $1,361 in 2025 and $9,797 in 2024. Interestingly, their effective tax rate is negative in both periods, which is primarily due to adjustments related to their deferred tax assets and valuation allowances. They're essentially carrying forward losses that offset their current tax liability. Here we see transactions with related parties, specifically with the Chief Financial Officer, Steve Neer. He received some stock options, but the reported share-based compensation for the periods in question was 0 for 2025 and a small amount for 2024. They are exposed to concentrations of risk. For cash, a significant portion can be uninsured, meaning if the bank fails, they could lose that money. As of July 2025, over $460,000 of their cash was uninsured, which is quite a bit when you consider their total cash. The concentration of risk on customers is also notable. In July 2025, 3 customers accounted for almost 96% of their revenue. Customer A alone made up 43.31% of revenue. This means their business is heavily reliant on just a few clients. In the prior year, 1 customer accounted for 100% of their revenue. That's a huge dependency. On the vendor side, in 2024, 1 vendor accounted for 54% of their purchases. In 2025, this reliance seems to have decreased, with no single vendor making up more than 10% of purchases. This section is management's explanation of the financials. They reiterate their business lines in consulting and healthcare products. The revenue decrease of 4% was mainly due to a shift in their business focus or customer base. The shift from Hong Kong in 2024 to the United States in 2025 for revenue generation is quite a significant change. Personnel and benefit costs decreased by about 35% compared to the prior year, mainly due to a reduction in management salaries, which is a cost-saving measure but could potentially impact morale or leadership capacity. General and administrative expenses increased by 15%, largely attributed to higher legal and professional fees. This could be due to an increase in regulatory scrutiny or ongoing legal matters. They ended July 2025 with more cash than liabilities, which is good. They don't have any off-balance sheet arrangements or contractual obligations to report. The positive cash flow from operations in 2025 versus a negative in 2024 is a really strong indicator of improved operational efficiency or better cash management. This is a crucial part of the report and it indicates some serious internal control weaknesses. Management admits their disclosure controls and procedures were not effective. This isn't a minor hiccup. It means the systems they have in place to ensure accurate and timely financial reporting are flawed. The report explicitly states a lack of a functioning audit committee and ineffective controls over financial reporting processes. These are flagged as material weaknesses. This suggests a significant risk of errors or misstatements in their financial reporting going forward. It points to a lack of independent oversight, which is fundamental in any public company. The exhibits include certifications from the CEO and CFO, as expected in these reports, confirming the accuracy of the financial statements. So what's the story with IGEA Group Corp? On one hand, they've managed to improve their cash position and generate positive cash flow from operations, which are definite positives. They've also reduced their overall operating expenses. However, their revenue has slightly declined and their heavy reliance on a few customers and vendors, particularly in the prior year, is a significant risk. The more troubling aspect is the management's own admission of ineffective internal controls and a lack of a functioning audit committee. This raises serious questions about the reliability of their financial reporting and the overall corporate governance. While they're losing less money, these control issues suggest that the company might be in a fragile state, and the numbers, while improving in some areas, need to be viewed with caution due to those governance concerns. The shift in revenue from Hong Kong to the US also indicates a potential change or challenge in their core markets or customer relationships. What's your opinion on IGEA Group Corp's performance and the red flags in their internal controls? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more corporate deep dives. Don't forget to join our Discord community linked in the description for more discussions. Thanks for watching and see you next time.